If you're looking for a simple and effective way to grow your wealth in the long term, you might have heard of the debate between index funds or investing in individual stocks. But how do they compare? In this video, I'll explain the benefits and drawbacks of both options and why you don't have to choose one or the other. Index funds are collections of stocks that track the performance of a specific market or sector, such as the S&P 500, the Nasdaq 100, or the Dow Jones Industrial Average. By investing in an index fund, you're essentially buying a small piece of the entire market, which means you get to enjoy the average returns of all the companies in that index. This has several advantages. Index funds are diversified, which means they reduce your risk of losing money if one or a few companies perform poorly, and they typically contain every company in the index they track. Some examples of popular index funds and what they hold are first, the S&P 500 index fund, and this fund tracks the performance of the S&P 500 index, which consists of 500 large-cap U.S. companies. The fund has a low expense ratio of about 0.03% and holds 505 stocks as of December 2022. The top sectors are information technology, healthcare, consumer discretionary, consumer services, and financials. Or for other fellow Canadians out there, the Vanguard FTSE Canada All Cap Index ETF, or ticker VCN, this fund replicates the performance of the FTSE Canada All Cap Index, which covers the Canadian equity market across all market capitalizations. The fund has a management fee of 0.06% and holds 216 stocks as of January 2023. Again, the top sectors in here are financials, energy, materials, industrials, and consumer discretionary. As you probably noticed in those examples of SPY and VCN, index funds are low cost, which means they charge minimal fees and expenses for managing your money. This leaves more money in your pocket to compound over time. Index funds are very easy to buy and sell, which means you don't have to spend a lot of time researching and analyzing individual companies or waiting for valuations on these companies to be below intrinsic value. You can simply buy and hold index funds for the long term. However, index funds also have some limitations to be aware of. Index funds are limited by their benchmarks, which means they can only match the returns of the market or sector they track. They cannot outperform or beat them. Index funds are subject to market fluctuations, which means they can lose value when the market goes down. They also don't offer any protection from inflation or currency devaluation. Then, index funds are also passive, which means they don't take advantage of opportunities or trends that might arise in the market. They also don't reflect your personal preferences or values. Individual stocks, on the other hand, are shares of ownership in a single company. By investing in an individual stock, you're betting on the future success of that company, which means you could potentially earn higher returns than the market average. This has some benefits with it. First, stocks are flexible, which means you can choose the companies that match your goals, interests, and values, and you can also adjust your portfolio allocation to your risk tolerance and time horizon. Then, individual stocks are rewarding, which means you can benefit from dividends, capital gains, and stock splits. You can also enjoy the satisfaction of picking a winner or supporting an investment thesis or approach you believe in or have developed yourself. Then finally, individual stocks are dynamic, which means you can take advantage of opportunities or trends that might arise in the market. You can also leverage your knowledge or expertise in a certain industry or niche. However, individual stocks come with their own challenges. Individual stocks are risky, which means you can lose a lot of money if the company performs poorly or go bankrupt. You also have to deal with the volatility and uncertainty of the single stock in the market. Individual stocks are costly, which means you have to pay fees and commissions for buying and selling them. You also have to pay taxes on your profits and dividends. And then individual stocks are time-consuming, which means you have to spend a lot of time researching and analyzing individual companies and their financial statements to truly understand them. You also have to monitor their performance and news regularly. So how do you decide between index funds and individual stocks? The answer is, you don't necessarily have to. You can have both in your portfolio. A mixed approach of holding index funds and individual stocks is an acceptable alternative that can offer you the best of both worlds. You can allocate a large portion of your money to, say, index funds for diversification, low cost, and ease of use, and then you can also allocate another portion to individual stocks for flexibility, reward, and dynamism. By doing this, you can balance your risk and return and customize your portfolio to suit your needs and performances. You don't have to choose being all index funds or all stocks. You can have both. Of course, this is not a one-size-fits-all solution. The exact mix of index funds and individual stocks will depend on your personal situation, goals, risk tolerance, time horizon, and investment style. You should always do your own research and consult a financial advisor before making any investment decisions. But hopefully this video has given you some insights into the benefits and drawbacks of both options and why a mixed approach is a perfectly acceptable way for investors to potentially construct a portfolio.